here's your host, Rod Khleif.
Welcome to another edition of Lifetime Cash Flow through Real Estate Investing. I'm Rod Khleif, and I'm thrilled you're here. And we are going to have a very interesting conversation today. I've got a gentleman named Brian Underdahl, and Brian is an expert in macroeconomic research, comprehending and deciphering economic trends. He's got an MS in Applied Economics from FSU. He's got a certificate in real estate investment and analysis from MIT. Very impressive. And he was an adjunct instructor actually in the Department of Economics. I'm assuming that was at FSU as well?
FSU,
yeah.
correct. Yep.
Welcome to the show, brother.
Thanks a lot, Rod. I appreciate it.
Absolutely. So why don't you do a much better job of saying who you are and giving a little more background and, just kind of let us know why economics maybe, why commercial real estate now, and let's start there.
Sure. So let's see, after undergrad, this would have been back in 08, 09, which was a fun time to come out of undergrad.
Yeah.
Had a sales career for a while and did that for about 10 years and then realized I wanted to make a change, went from sales to economics. And that's when I went back for my graduate degree at FSU. Really enjoyed it. I was into Forex trading for a while too, and that's what prompted me to go back to get a degree in economics because I just loved it. While I was in grad school, I met up with a great company out of Tallahassee, hedge fund there, and they let me come along and intern and later work with them. From there, they asked if I would head up a real estate fund-to-funds model, so we were investing passively in syndications and sponsors, primarily in the Sun Belt and Southeast, exclusively in multifamily, though.
Could you explain for my newbie investors that listen and watch this show what a fund-to-funds means?
Sure. Well, the simplest way to put it, it's a fund that invests in other funds.
Right. So you've got operators like me and other syndicators that go out there and they find deals. So you're basically vetting the operators and deciding and vetting the deals as well, obviously. And then you invest. You have a fund that invests in their deals, and you get a little better deal than the typical, $100,000 LP investor in those deals.
That's right. Yeah. So in fact, that was my primary role was to vet, if you will, the sponsors that we were looking to work with, and then we would also, alongside that, look at the deals themselves.
Sure. And so please continue. Bring us.
Sure.
Going. Sorry.
So let's see, I guess starting about 2 years ago, we just couldn't find any deals that made sense that we wanted to invest with. Even if we liked the sponsors and we understand they needed to keep doing deals, we were kind of pencils down, if you will.
Right.
And then I guess right before the Fed started hinting that they were going to be raising rates soon, we just realized that most of the deals that we had just underwritten the last 5 years were on floating rate. Bridge debt and what that might mean. Of course, even we didn't predict that the Fed was going to raise rates.
11 times, right?
Yeah. So then we started thinking about the deals that we had previously underwritten and what that meant for them, and just knew that it
wasn't good. Right.
Then we started to have a couple of groups that we had, syndicators that we had spoken with before, come to us and see if we would be willing to do some sort of pref equity on their deals. And we were able to help on
people in trouble.
Yeah, correct.
Right.
But not in the type of trouble that we're, I think, seeing now and we'll see more of. This was more of I need $1 million for a rate cap extension or something. And then we realized that some of the deals we were starting to see that we couldn't save, we couldn't help. Pref wasn't going to help them.
Right.
And that was around the same time that my partner and one of my partners, Stuart Keller, he's the CEO of Nuvo. He was one of the sponsors that our group actually wanted to invest with still, but he went out on his own. He's got about 16 years in the industry as a property manager, asset manager, and again, was one of the groups that we wanted to invest with. So he asked me if I would come along and basically take what we were seeing at my old shop with the distress in the market and see if there's an opportunity there to actually build a business strategy around it. And that takes us to today. So we're actively underwriting deals. Our strategy is a little bit unique in that we try to include the selling sponsor in our deals. So when they sell, they get to become a passive part of our deal, and then get a piece of the carry when we sell down the road.
Right. Could you elaborate on that a little bit more?
Sure. So If you have a deal that's struggling right now, you really have a couple of options. Maybe you can raise preferred equity for it. Maybe you can sell it outright on the market. But what's happening right now is that the values of the properties have gone down with cap rate compression or expansion, excuse me.
Right.
And so if you sold it, you might be selling it for what you have in it. You might even be selling it at a loss, and you might not even be able to get, in some cases, the value of the note or what you still owe.
First mortgage, right?
That's right. So we're providing an alternative option for the sellers to where they can get out from under the debt, so that they don't have to worry about the burden of debt or face foreclosure, which we all know will not look good on the record going forward, and certainly won't help getting financing in the future.
Right.
So it's a way to kind of cut your losses with that property, keep sourcing new deals and continuing the business while still knowing that if you sell to us, that property may still be able to give you a return in the future, basically.
And so they get a little piece of equity in your company, correct, or something? That's how you structured it?
It's basically structured so that the existing entity becomes a partner in the new entity that holds the property.
Gotcha.
Yep.
Okay. And do you see limited partners being out of the picture in that scenario, or are they gonna be out? Or
so that's the reason we structure it by acquiring the existing entity or bringing the existing entity along, because the LPs are part of that entity.
I see.
So when that entity receives a distribution, it then flows down to the LPs.
To the LPs. So everybody's quasi whole at that. I mean, even better than whole, really, if they're getting some return still.
Well, and that's where each deal is going to be different. So if there's still equity left in the deal and it rolls over, then yes, you have a chance to be made whole, make a return.
Right.
But if the deal has no equity left in it,
right.
like we're paying the loan balance
right.
to acquire it, then we're just giving a piece of our carry to the selling sponsor. So it's not tied to the equity they're bringing over, because there's no equity coming over.
Got it. And there's quite a few that don't have any equity.
There are.
I know. A lot of deals are going south right now. So, we talked briefly before we started recording. I mean, it sounds like a very intriguing business model, and I could see how that would appeal to sponsors, because they're not completely out of the picture. They're not completely destitute, and they're able to, at the very least, not have a foreclosure on their record. So you obviously are thinking there's going to be some deals coming down the pike, which is why you set up this business model. Why don't you speak to that a little bit? You've got a lot of background in economics. Where do you think things are headed in our commercial real estate world and in the multifamily world specifically?
Sure. So again, my expertise is focused on multifamily, so I'll gear it towards that.
Okay.
So there's roughly $136 billion worth of multifamily loans that were originated in between 2019 and 2021 that are all maturing in 2024.
I thought it was more than that, actually. I've seen articles that say it's half a trillion. But
so it depends on. So this is a very specific stat. It's for the floating rate bridge loans that were originated in those years are maturing this year.
Just bridge debt.
Yep.
Got it. Okay.
So by definition, the interest rate they went in at is not what it is now.
Yeah, we've seen reserves. I was looking at an asset in San Antonio where, these lenders will make you pay reserve payments in anticipation of a rate cap, and the guy's payment went from $8,000 a month to $80,000 a month.
Yeah.
That's a little sobering.
Yeah, there's not many business plans that can absorb that.
Right.
Yeah.
And so you're saying $136 billion in that bridge debt, and that's $136 billion that's got sweat beating on their forehead right now, looking for a solution.
Yes.
And that's by the end of this year.
End of this year.
Yeah.
Yep.
It's not an insignificant amount.
No, and even some of that, even if it spills into 2025, it's not a perfect stat, because there's some extensions that are happening right now from the lender side where things are being worked out. So that was as of 4 months ago. That was a relevant stat.
So that's why you did the business model. But going more macro now, speak to what you think is going to happen in our world. I mean,
there's a lot of mixed signals right now. So you've got indices like S&P doing the best it's ever done.
Right.
At the same time, you've got pretty substantial layoffs at major companies. You can just Google it and you'll see who. And then you've got non-farm payrolls that are actually coming in higher than expected each month. So, yeah, a lot of mixed signals. I think
Housing,
of course,
right.
Single family doing just fine, very resilient.
And there's a huge pent-up demand
Yep.
for housing. I mean, I think we're short 2 to 3 million units right now. Is I read that somewhere.
Yeah,
So
and even if you own a home right now, you're not selling it.
Yeah, because you got to get a higher interest rate if you buy another one.
Yep.
So
So-
there's
so-
pent-up demand.
Yeah, supply will remain constrained there.
Right,
Yeah.
right. So do you have any predictions? I mean, we all want the crystal ball. Do you have any thoughts about? I mean, I think it's inevitable that the Fed will lower the rates just on pressure from the current administration to help with the election. But what are your thoughts there?
Yeah, so I'll preface this with economists jokingly call themselves, the weathermen
Right.
of the markets, because we can predict something. If it's not right, well, we told you it was a 50% chance.
Right,
So,
right.
So my personal opinion is that, and we're already seeing this play out, is that the Fed's not going to cut as aggressively as people were hoping.
Right.
Each week that goes by, the probability of a rate cut goes down. And so the number of rate cuts that are predicted over the next year just keeps dropping.
Yeah.
I think the deciding factor here, you mentioned the elections. I'm sure there's some of that going on in the background where but I can't point to something and say that. I think that the Fed's bigger fear is that inflation takes off again. They're less concerned about a recession than they are about inflation going out of control. So if we continue to see persistent inflation, or even inflation not coming down as quickly as they like, they've got cover to hold rates higher for longer. And so if you made me answer you today, that's what I would say, is that rates probably are going to stay higher for longer. We might test the waters with a cut or two, but if some of that data starts coming back looking like inflation's not going down, then we're likely going to see persistently high rates or higher rates.
Which is not a good sign for our business.
It's not.
I mean, for a lot of operators in our
existing,
business. I mean, I'm an opportunist. I think there's going to be opportunity with it, but so your thoughts on that?
Yeah, for anyone that's looking to do, hoping that rate cuts or rates coming down are going to save an existing deal, I would just really caution that, because they're not going to come down at the velocity that they went up.
Right.
And so people on the acquisition side are still going to be hesitant to come in at, let's call it last year's valuations.
Right.
And so the chances of your previous valuation being the same in the next year is very unlikely. Now, this is all market specific, but just I'm talking in general here. So it's going to take a while before the valuation that you purchased at in 2020 or 2021 for your property to be that value again.
Get there again, yeah. Yeah, no, we're seeing that too. So I know you're in the multifamily space, but let's talk office for a minute.
Sure.
I mean, there's billions and billions of dollars in office assets that is 50 to 70% occupied in major metros in this country. A lot of that debt is held by small and regional banks. Now, I know we were talking about this before we started recording. Lenders are much more pliable right now. They even got a directive from the Fed that if you've got a credit-worthy borrower, you should be working with them to work it out. But what are your thoughts, a little more macro, stepping back to the commercial real estate world in general? And I saw an article from I wish I had his name, a fellow from India, talking about a CRE tsunami. Would you see that one? Do you know who I'm talking about?
I do.
Yeah, okay, yeah. And I mean, what are your thoughts? Is it just a doom and gloomer, or is there some merit?
I'm a lot more bearish on office than
Yeah.
multifamily.
Yeah.
I think most people are. But office has a really unique problem where what
What
do you do?
Exactly. I mean, if you can't convert them to multifamily or storage, what the heck? Or maybe what do they call it? A bank of computers, a computer center or something. What do you turn them into?
Yeah. So the newer office space is actually doing quite well. And what people want now to pull them out from the home and get back into work is more amenities and much,
Yeah, they don't want to leave the house unless they've got the Google amenities and whatnot, But Yeah.
So the older ones, they're worth less than the property itself because you have to tear down that property to do something else.
Right. So from a macroeconomic standpoint, you're an economist.
Yeah.
That's kind of sobering for the economy, isn't it? For the commercial real estate, maybe not the economy in general, but the sector.
It certainly is. And I'm not sure what the solution is. I don't know.
Or the outcome.
Or the outcome.
Yeah, it's the outcome I'm worried about. I mean, I don't know that there is a solution except carnage. That's why I'm asking, because it's a lot. It's a lot of debt that's in trouble.
There will likely be some large reset of valuations, which is already happening. I mean, it's I wouldn't say it's bottomed out yet. And then those that are stakeholders in those assets get hurt the worst.
Yeah.
And I don't know that it'll get far enough along to where there's some sort of bailout there. I'm not predicting that.
And they want to increase inflation. If their inflation is truly a factor, then they better just let the chips fall. But
how I think it could play out is that a lot of these regional banks, smaller banks, and that hold a lot of this office debt will be acquired by larger ones. So we saw something similar with SVB. So the Wells of the world will come in and acquire, and we'll have more consolidation of lending institutions and fewer options for folks like you and me that are trying to get
a bigger
loans.
footprint. Yeah, they get a bigger footprint. So you're talking about banks being acquired, but I'm thinking there's going to be some bank failures, which is why me personally, I've got my deposits at this sweep clearinghouse bank that spreads it out over 80 banks at no more than $250,000 per bank.
Right.
You familiar with that model? Yeah. And decent interest rates, actually. I'm getting 4.5-5% on my money. But what are your thoughts on bank failure?
Yeah, I think I agree with you that there will likely be more bank failures going forward. I mean, we just had it with New York. Well, they didn't fail, but significant cut to their earnings projections and basically acknowledge the problem with their loan performance. So
commercial debt.
Yeah.
Yeah.
And so it's just going to, I think the dominoes are starting to fall there.
Right.
It started last year. We're going to see more and more. And
doesn't it have to? We're talking 50, 60, 70% occupancy.
Yep.
I mean, massive write-downs, right? I mean,
massive.
We're talking, I mean, I don't know if it's trillions, but it's definitely hundreds of billions.
Yeah, I think it is just over $1 trillion.
Is it?
Yeah.
Wow.
So of commercial
number.
real estate debt. Yeah.
Yeah. So the Fed's only options really are to either keep the rates constant. And I don't stay as in tune with this as I should. Are they still tightening? Are they still doing quantitative tightening, or what do you know?
Yeah, I mean, that one's kind of tricky.
Pulling money out of the market. In
Yeah,
other words, for those who don't know what that means.
They basically, by holding rates where they are, they're having that effect.
Really?
So
Okay.
that's naturally pulling money out of the market. There aren't transactions happening in housing. There aren't transactions in multifamily, commercial. So it is removing liquidity from the market.
Yeah.
So in that sense, they are tightening. On the flip side, you look at the debt payments that are expected to go up 20 trillion in the next decade, and so that implies that you need more money in the system. And so from that standpoint, it's quantitative easing.
Right.
But the effect of what they're doing right now is the same as quantitative tightening.
Yeah. Let me ask you this, and this is, I hadn't planned to ask you this, but I just thought about the huge debt we have as a country.
Yeah.
I mean, who knows what the real number is. It's staggering beyond belief. And I had an economist sitting in that chair, I don't know, 6-8 months ago, that said the interest on that debt right now, I believe, exceeds or comes. It's like close to what we collect from the IRS every year. I mean, it's insanity. Yeah. Like we're borrowing to pay interest.
Yeah.
Do you have any thoughts on that?
Yeah, that's a serious problem.
Yeah.
Entitlements like Social Security, Medicaid, those basically equal what we're bringing in. Like you said, well, it's not exactly. I forget the exact percent,
right.
But it's a huge portion.
It's scary when you see it side by side. I mean, how do we continue?
Yeah.
You know,
printing more money.
Well, but at some point, I think I have a bill in my drawer in my other office that's like $100 billion. I forgot what country it is now, but the money becomes worthless.
Oh, Zimbabwe, probably.
Zimbabwe, it was Zimbabwe, yeah. And I mean, at some point, the money becomes worthless. We saw that in a Latin American country as well. I forgot the country, but that had massive hyperinflation.
Yeah.
And then you see, I'm not a conspiracy theorist, but you see all these things where these BRIC nations are leaning over to the yen, and they don't want to trade in dollars for gas anymore. And I'd love to get your thoughts on that, if you give that any energy at all.
Oh, I do.
Okay.
And I think it's a legitimate concern. Yeah. I think it'll take longer to play out than maybe in my lifetime, our lifetimes. It may, but I think this is more of a 30 to 50 year problem if we don't do something about it. So it's the writing's on the wall with the BRICS. They essentially are trying to make it so that we don't have to do trade in U.S. dollars. Right. That's a huge part of the U.S.'s success over the last, since World War II, I guess.
Right.
That we kind of had to do trade in U.S. dollars. So China and the like play a long game.
They work in decades. They don't work in a year at a time. And the whole Asian community. I mean, we saw that with Japan. When I was younger, they think in terms of decades. Like they took over the TV industry by cutting costs and losing money for years, and took over the TV. I mean, hey, God bless them. I mean, they're smart, but I think that's what's happening with China right now as well, and not just economically, but in influence as well. You see the amount of money they're spending in some of these other countries for infrastructure, and I just saw an article that they are heavily in control of the area where most of the lithium is mined in Latin America, or maybe it was Latin America. They're playing the long game for sure.
They are. The Silk Road Initiative, I think you were alluding to there.
Yeah, exactly. Yeah. And it's sobering when you think about what could happen. Better start learning Mandarin, I guess. But it's like back to multifamily. Thank you guys for humoring me on that conversation. That was more from my own personal interest. But you see opportunity. I mean, I think it's going to be pain. There's going to be carnage. But with crisis comes opportunity. Is that an accurate opinion?
That's accurate.
Yeah.
I would also say, so NUVO actually stands for never underestimate valuing others.
Nice. Okay, that's a nice altruistic way to present it.
That's part of where our strategy came from, is that there is opportunity. We've got a lot of partnerships in the multifamily space, and our thinking was if we can make money ourselves by helping people in some small way, then it's a win-win, and we'll all come out, a few years from now better off for it. But I do, to answer your question, think there is opportunity if you have capital to deploy, basically. So, we started this company just last year, but we spent the last 9 months just working with our equity partners to prepare them for this opportunity, basically.
You're dealing with larger equity players?
For the most part, yes. Family offices and institutions, alternative asset managers, hedge funds, that sort of thing. Nice.
I'm hearing opportunity funds pop up all over the place. Your business model is unique in the fact that you're offering something back rather than just taking. I mean, I feel like right now there's blood in the water and sharks are swimming about. And would you agree?
I would agree with that. Yeah. Also, a lot of that stems from the personal relationships that we have with this community. Yeah. So an outside hedge fund may come in and just say, what's the lowest price I can get this at? Right. Whereas that's not necessarily part of our strategy. We need the numbers to work for us and our investors. And if they do, then
you're not trying to get every freaking drop of blood.
Yes.
In other words. Yeah. No, I like that. And you don't know my story. I lost $50 million in 2008 and 9. So I've been through this before. And I recovered. I'm back. So I feel bad for the people that are going through it. I'm going through it on a couple of assets right now, and we'll get through it. It's gonna suck, but we'll get through it. But if you're listening and you've got a troubled asset, just realize you can get out the other side of this, and you just got to stay focused. Don't wait. Don't be reactive. Be massively proactive right now. Communicate with your lender. Over-communicate with your lender right now, correct?
Correct.
Yeah. Any other strategies for someone facing a challenge right now?
Well, don't give up and
give up.
don't put your head in the sand.
Yeah.
To put it bluntly, it's you can't just hope that there's a solution that's going to present itself. You've got to figure it out on your own.
That's it. And you if you plan, you focus on plan A, you better have B and C thought out as well.
Yep.
And just do everything you can. And like I say, over communicate with everybody, your investors, your lenders.
So we were talking about BRICS earlier.
Right.
They're trying to remove the need to pay for oil in U.S. dollars.
Right.
That's 100% happening.
Yeah.
And the hope is basically to just make it so that they don't have to trade in U.S. dollars anymore.
Right.
There's another, there's a lot of talk about how China and all those countries are selling U.S. treasuries, and who's going to be.
Is that accurate?
It is accurate, but mixed on why.
Mixed on why. Okay,
So
interesting.
there's a train of thought that they are selling those because they need U.S. dollars. They're selling their treasuries because the U.S. dollar is in such high demand.
Interesting. And I've read that too. I saw, you get these conspiracy theorists, I don't even know if that's an accurate word to describe them, that are freaking out over these alliances between these nations to stop trading in the dollar. Yeah. But then I saw a counter argument that the dollar is still the belle of the ball in a big way, that there's billions and billions in mattresses around the world, and so on and so forth. Would you agree with what I'm saying?
I do. The dollar is still reigning supreme
which
here.
is why you said it could be 30, 40 years before things change, and who knows what that timeline's like. But but they have a plan, and they're. And I will tell you, and this will piss some people off, I used to think we were the good guys, but in light of some of the things I've seen over the last 4 to 6 years, and the administration and some of the things we've done and are doing, and the censorship and the propaganda and everything else, I think I can see why there are a lot of countries that would be angry with us. What are your thoughts on that?
Yeah, I guess, I'm not old enough to talk about 80 years ago or anything like that,
right.
but I would just, in economics and in history and in general, there just seems to be a pattern of history repeating itself, if you will, where all the way back Roman Empire and before that, where you get too big to fail, or you think you are, and then somebody surprises you.
Right.
I'm not sure what the catalyst would be.
Well, you remember the savings and loan crisis, where you probably weren't even in business.
Studied it.
You studied it. Okay, I was there. Okay. I remember when I got in the business, interest rates were 18%. True story. And I remember just being so excited when they hit 7%. But so the savings and loan was a big, massive one. And then, of course, 08, 09 crushed me. And then, so who knows what the next, catalyst will be. I thought COVID was going to do it. In fact, I did a YouTube video, said the coming crash of whatever year that was. Yeah. It was the most highly watched one I ever had. And of course, I got a lot of hate. You're such an idiot and whatnot. But, I really thought that was going to be it. And of course, we multifamily did just fine. We got hundreds of thousands of dollars in our assets and rent relief, and so it was the right asset class to be in through that. Office didn't get money, retail didn't get money, industrial didn't get money, but we got some. I mean, they got payroll money, but that I think played a big role in the inflation. Yes.
Yeah. I do. I think something really interesting is that consumer confidence still seems to be so high right now.
Right.
But you've got a Happy Meal costing $10-15. I mean, it's.
I'm recently single, and so I'm buying my own groceries, and I'm like, are you freaking kidding me?
Yeah.
I mean, I'm shocked. Filling up my car is over $100. I'm like, are you kidding me?
Yeah.
And I just wonder, which is why I'm not interested in C-class assets right now, because I think that demographic that's going hand to mouth is dying. I mean, they're getting their butts handed to them. Would you agree or no?
So I agree with part of that.
Okay.
What I would say about C or C+, C-, whatever assets that is true, but it depends on what the makeup of that group is. So
it's more, okay. You got to go a little more micro into what's in there. Okay, I agree with that.
Because I think blue collar jobs that have to be performed by a human, I am very, very bullish on.
Yeah, they're not going anywhere. And we've seen, of course, big increases in pay as well, huge increases. I mean, in a very short amount of time. So, it is. It is counter to those high prices, but
a big part of what what we think you should look at if you're looking at a C-class property is what the AMI is right there, so that
Explain AMI for the.
So the area median income, it's basically how much folks in that area are making.
Right. And you can discover that, by the way, on sites like city-data.com, bestplaces.net, datausa.io, and of course some of the more business-centric ones that we use. But yeah.
And the Federal Reserve has their own.
Federal Reserve as well.
The stat they use is burdened households, and that's if you're spending more than, I believe it's 35% of your income on housing.
Yeah.
And so we use that as a threshold ourselves, which I would encourage anyone to do.
Right. Now we don't rent to anybody that doesn't make 3 times what the rent is. And so, we're doing an analysis. I'm sure you do the same thing. You've got to look at that that AMI to determine that. And
more importantly, on your pro forma on exit in 5 years, where is it going to be? Because if you've got a price per door of $200,000, but that would put the next buyer above that AMI threshold, then who's going to buy your property?
Exactly. Yeah, that's the rub on the pro formas. Trying to calculate what's going to happen with rents, trying to calculate what's going to happen with income, what's going to happen with expenses. We saw huge run-ups in building material costs for a while there, and supply chain issues, and on and on and on.
So that's actually another area that I think we're going to see distress is in new development.
Yeah.
We've got a glut of supply.
Already seeing it right now. Yeah. I've got friends that have a lot of money that have land that's sitting there that they can't finance right now. They can't pull money in. I told you about the problems I'm having right now, and that particular situation. There's 7 land deals involved there, and there's some struggle. They're trying to finance one deal that's already started the renovation. The lender actually went out of business, is what I've come to understand. So, yeah. I think you're right. And so what are your thoughts there? Is there opportunity in development?
There's an opportunity to do something similar to what we're doing with existing properties, whereby the developer has a construction loan that's coming due.
Right.
Or maybe they can't move on to their next project until they close out the last one or get that financing taken care of. So we can do something similar in that space as well.
Oh, that's good. Yeah. These deals, you'll raise money to buy the land. You'll raise money to entitle it. Then you raise money to finance the vertical, and did I miss a piece? And then is that about right?
Yeah.
Did I explain that correctly? Yeah, because that's not my wheelhouse.
Me neither.
I'm learning it very quickly right now because of what I'm dealing with. But yeah, and like I said, I've got a good friend that's got 9,000 units and a big net worth and liquidity that's struggling to get some ground that he owns in fantastic areas in Texas out of the shovels start moving.
Yeah.
That
side I can't speak to as much. We get involved or are more interested in the pre-lease, leased up.
Gotcha. After
pre-stabilization.
After it's done and you're and there's a real I think opportunity there for sure. With those assets as well, because a lot of these developers will build it, they'll try to pre-lease it, or they'll sell it to somebody as soon as it's built.
Yep.
So you want to get into that mix somewhere then.
That's right.
Yeah,
and we're actively doing that.
You are? Okay, fantastic. Well, you've obviously got a Rolodex of people you've worked with and reviewed. You said how many syndicators did you say you've analyzed?
Close to 600 over the last
600. Wow.
5-6 years.
So you've got relationships with a lot of people.
We do.
A lot of people that did deals. A lot of people that could be in trouble on deals, and could be some opportunity for win-wins there.
Yep, that's the hope.
Yeah. No, I like it. And you're going to stick with multifamily. You're not interested in any other asset classes. Do you see any other opportunity in other sectors of the economy? Because I tell people, figure out how you're going to take advantage of this, because opportunity's coming. I think opportunity in businesses. There's 80 million baby boomers, and they're getting old and getting cold. That was my line. So they're going to come south, but they also have a lot of businesses that they want to retire from, and I think there's an opportunity there. Do you? I'm sure you think about it, but maybe you don't give it any energy. How about other asset classes in real estate? Are you any thoughts on opportunity there?
So one thing, Nuvo, we only do multifamily.
Got it.
And in fact, if we come across some other opportunity that we'd like to be in, we pass it along to someone we know.
Put your friggin' blinders on and say, focus, focus, focus. No shiny penny stuff.
We call someone that does that and tell them about the deal.
Got it.
As far as you brought up something I'd love to talk about, but the small, medium-sized businesses and baby boomer generation retiring or selling, there's an entire movement right now within, call it the MBA types, where instead of going off and starting some tech platform startup, they're actually just rolling up
these small businesses.
those small businesses.
Oh yeah, that's like Wayne Huizenga did with Waste Management, and rolled up a bunch of garbage collectors and turned into a freaking gazillionaire rolling those up.
Yep.
I've seen that happen in the funeral industry. What are some industries have you if you're in tune with?
Electricians, plumbers, and
no
like
kidding.
HVAC and
No kidding, rolling those. Oh yeah, you know what? I know about a guy doing that as well.
Yep.
Where basically, so what that means, guys, is you'll put a company together, you'll buy an HVAC company, and then you'll offer stock in the main company to someone that you're buying another company from, and that's it's very often how a roll-up is done, where whoever you're buying these different companies from will get pieces of the big company, and you can point to some future opportunity in the value of that stock, because you're going to be buying a lot of companies. Yeah, that's a proven awesome business model.
And it just happened in my backyard, actually, in Jacksonville.
No kidding.
Where we had like the biggest electrician, the biggest plumber. Now they're under the same name.
No kidding. So rolled different ones,
correct,
together.
different professions, and now they've got a master GC, if you will, that
interesting.
you call
so
if you need electrical, plumbing.
HVAC, you do all three in one. I've seen that here as well.
Yep.
I've seen that here when they're huge.
Yep.
Oh, that's a great idea.
That's happening because there's a lot of value left in those companies, because the mom and pop, if you will, operators for the last 40 years, they're not maximizing efficiencies. They're not looking
marketing,
at it like
tech, AI. They've done it the same way every time, and and can't even spell the word technology. Yeah, no, that's very interesting. I wish there was 5 of me. One of them would definitely go do that, and do something else.
I do think as far as interesting within the real estate asset classes, industrial, I still bullish on, but I don't do anything with it. I know great guys that do that. That again, I'll point people to, but try to stay in our lane as far as
What do you think about retail with the whole Amazon dynamic?
What do you mean by the Amazon dynamic?
Well, people ordering online.
Oh, right.
Okay, where I mean, if I want something, I don't care if I want some of these notepads or a phone or food or spices. I just got my curry spice today from Amazon. I don't go to the store anymore unless I'm going to try on some clothes. I don't go. I bought my sauna online. I bought, we bought all this equipment here in this video studio online. So I know there are some retailers that well, restaurants and fitness centers and things like that will be fine regardless. But I was just curious, in general, your thoughts on retail.
Yeah, in general, I think there's even a push within retail now to become more of an experience. You go out and you shop for your clothes or whatever it is, and it's because you're having fun doing it, and anything that isn't ticking that box is probably going to struggle.
Yeah, there's a big mall that used to be the belle of the ball called Sarasota Square here that's dead. It's completely empty. There's a Costco on the end, and who knows what they're going to redevelop it into. It's prime real estate. But then you go to University Town Center, which is a big outdoor area with a big mall, but the whole area has become this incredible hub of businesses and restaurants. And man, for Christmas, I wanted to go there just to see the lights. It was so beautiful. So they've turned it into an experience, and it's beautiful and brilliant. A family called Benderson, I think, controls most of that, but here locally. But so retail, a lot. Great feedback on the experience component. Industrial, still good.
Pickleball.
Yeah, it's really funny. We've got an asset under contract in San Antonio. By the way, if you're accredited, text the word partner to 72345 and check that out. So we've got a 296 unit asset on the same road, a mile down the road. We're buying a 200 unit asset, and there's a tennis court there. And I've never even seen pickleball. My team's like, we got to put pickleball on this tennis court. I'm like, whatever, let's do that. Fine. So we're doing that. But to give you an idea of the deal, the one next door sold for $237,000 a door. We're getting this one for $200,000.
Wow.
And it's the same vintage on a lake on one side. It's 37 units on a lake, a golf course on the other side. It's just a screaming deal. It was under contract for $26 million. We're getting it, and it fell through. We're getting for $20 million. I'm real excited about it. Now, the units in this place are much bigger and nicer than the one we already have, which is killing it. There's 296 units, killing it. It's always in the 90s. This one every unit has fireplaces, every unit has washer-dryer hookups, which we don't have in the other one. Bigger, So we're real excited about that one. Yeah. So
Congrats. That
yeah,
sounds
thank
great.
you. Yeah, it is a home run. That's the first one we bought in, like you said, in a year and a half.
Yeah.
You haven't bought in a year and a half. It's the first one we've got in a year and a half as well, because we've put pencils down. I mean, well, we kept looking, but
Right.
we were and mounting frustration, but we didn't pull the trigger on anything until this one popped up. So, yeah, very exciting. You know, I wish I had that freaking crystal ball for, what's happening in this country. I get asked all the time. I'm like, if I knew that, I'd be on the back of my 300-foot yacht, but, I think there's opportunity in any part of the market cycle. You just have to, take a look at it. And people say, should I wait to buy real estate? No. If the price is right and the cash flow is right, buy real estate and wait, right?
Yeah, you keep moving forward, but mitigate risks along the way.
It's all about risk. Yeah. What's Warren Buffett's famous quote? Never lose money, and then B is go look at A or something like that.
Don't forget rule A, or
right,
rule number one.
right.
Yeah.
Well, it's very much a pleasure to meet you. I very much enjoyed this conversation. I appreciate you coming down. I know it's a bit of a hike, and maybe we'll circle back in a year or two and see where you're at and see, if you're able to help some operators out and put some nice deals together.
Rod, I've known you were around for a long time, and when you invited me to be on the show, we kind of dug in a little bit, and just wanted to say that I like what you're doing, and there's a lot of other coaches out there, but the way that you approach things, I think, is really helpful for your students. So I was very happy to be on the show.
Pleasure. So one other quick thing. We encounter so many people that are frankly frustrated. They're looking in the mirror and they're frustrated that they haven't been able to escape the rat race. They haven't been able to build cash flow to the point where they're able to have financial and time freedom with their families. And maybe they see other people buying real estate and creating, incredible cash flow, and they think, well, it's just scary. Buying apartments is intimidating. And I get it. See, that's why we created our Warrior Mentorship Program. They're our coaching students, and they've had extraordinary results. My students, I've been teaching about 5 years, and they own upwards of 140,000 units now that we know of, right? And we feel like it's just getting going. Now, we're looking to grow this group and really take it to the next level. And honestly believe that the greatest transfer of wealth could be upon us right now with this current economic environment. Everything's going on sale. So we're looking for people who want to follow a proven framework, really like a blueprint or a map, literally step by step. And then they're able to leverage our systems and our incredible network to raise money and equity, to find deals and close those deals and build partnerships, really nationwide. So if you're interested in finding out more about how you can become more in our incredible network and take advantage of the unbelievable opportunities that are upon us, you can apply to my Warrior Mentorship Program by texting the word CRUSH to 72345, or you can go to mentorwithrod.com. And what we'll do is we'll set up a call so you can check us out and we can check you out and see if it's a fit. Now, again, you can go to mentorwithrod.com or text the word CRUSH to 72345 to apply, and we will speak soon.